In this video, we will be taking a look at Leggett and Platt's first quarter 2023 earnings results and their subsequent dividend announcement that definitely surprised me a little bit. In a recent video a bit over a month ago, I said this about Leggett and Platt's dividend, but overall I am on the confident side that they will continue at the same dividend rate in 2023, and then we'll be able to fully cover a small dividend raise in 2024 from their net income alone. And oh boy, could I have been more wrong. We'll talk about the dividend a little bit later on in the video, but first let's take a look at their first quarter earnings, which they released on May 1st. Top line revenue for the quarter was $1.21 billion, which was an 8% decrease compared to the first quarter of 2022. The bottom line net income for the quarter was $53.5 million, which was a shocking 41% decrease from the record first quarter of 2022. This is certainly not a good sign, but there are a few factors that make this look a little bit less bad. First of all, the first quarter of 2022 was an exceptionally good quarter with revenues and net income bolstered by large raw material price increases that were passed along to customers. Additionally, in the Q4 2022 earnings release, management stated that they expected first quarter EPS to be down meaningfully versus the fourth quarter, but that was not really the case at all. EPS was exactly the same at 39 cents for the fourth quarter of 2022 and the first quarter of 2023. So they definitely were a little bit above their expectations in that regard. So the quarter was really not the greatest, but it wasn't as bad as management as expected it to be. Looking at earnings a bit more in depth as well, we can see the organic sales were actually down 11%, and then acquisitions added 3% back in for the overall revenue decrease of 8% that we mentioned earlier. And breaking up that 11% decrease in sales that we just mentioned, volume contributed for 7% of that decrease, and then raw material prices decreased the sales additionally 3%, and currency impact decreased the sales that final 1%. A big part of the decrease in earnings as well was lower margin in the steel rod business, which ultimately makes sense. Generally, Leggett and Platt tries to change the price of their products that they sell to customers as the price of their raw materials fluctuates as well, but they don't want to lose too much in sales, so they also don't want to make those changes super drastically and super quick. So those changes generally lag the fluctuations in raw material prices, and they don't want to sacrifice volume as well, so they end up sacrificing some margin and profitability there. Looking into their financial position, their debt is currently sitting at $2.1 billion, which is about 1.7-ish when we factor in the cash on hand to find the net debt. And that's definitely higher than I'd like to see, given that the 2023 earnings are likely going to be in the range of $220 million. But they have no significant maturities of debt until November of 2024. I think their current maturities of long-term debt is something like $9 million, which is definitely manageable. So that is good to see that, they don't have much maturing until the end of 2024, and that will give them some time to recover and rebound their business over the next year and a half before worrying too much about debt. They also list a metric for debt, which is to say that net debt is only 2.88 times their trailing 12 months adjusted EBITDA, but I personally think this number is sort of not super meaningful for Leggett and Platt. It definitely paints the debt picture, I think, in a bit more rosy fashion than I think it deserves. Although this means they could theoretically pay off all their debt in 3 years if they wanted to. They would still owe interest over that 3-year period, which would likely amount to an additional $200 million or so. So it'd probably take them a little bit longer, and that 3-year time horizon isn't super realistic in my opinion, but I don't think the debt situation is all that bad. Their average interest rate on their long-term debt is 3.8%, which is really not that bad at all considering the current interest rate environment we're in. And additionally, the average maturity of their debt is 11.2 years, which I like to see and kind of fits in line with what we saw earlier, that their next major maturity isn't for another year and a half. There were also a few interesting updates I found in the 10Q report that wasn't included in the press release. And the first of these is that logistical and supply chain problems related to the pandemic and its aftermath are pretty much gone at this point for Leggett and Platt. However, they did note that the semiconductor shortage is actually affecting their business a little bit, and the reason for that is that the automotive industry is short on semiconductors essentially, and so they're not producing as many cars, and therefore they're not requiring as much product from Leggett and Platt, which is lowering their sales a little bit to the automotive manufacturers. But hopefully that will, kind of subside in the short term. And additionally, as I mentioned earlier, another point that they talked about was commodity prices, both in steel and then also in some chemicals that they use. And these are still going down, which are going to negatively impact their earnings in the coming year. Coming now to the dividend, on May 4th, they actually announced a second quarter dividend of 46 cents per share, which is a 2-cent or 4.5% increase from the prior dividend. And this is now the 52nd year that Leggett and Platt has paid increasing dividends, and their current yield is now about 5.5%. Me personally, I was honestly pretty shocked by this increase. I wasn't really expecting any raise in 2023 at all, and they still would have kept the Dividend King streak alive even if they didn't raise it in 2023. And if we did see a raise, I was certainly expecting a skimpy 1 cent per share, not this 2 cents that we got. And they did raise it, like I said, by about 4.5%, which is nothing to write home about compared to some other companies that I invest in, but it's actually above their 5-year average dividend growth rate of 4%. And it's even better than the dividend raise that Apple recently announced, which was only about 4.3%. So like I said in my last video on Leggett and Platt, 2023 is definitely going to be a tough year for the company, but I still have general confidence in the safety of the dividend, especially since management just increased it by about 4.5%. And I think they can make it through this dark spot and start to recover towards the end of 2023 and going into 2024 and beyond. I think it'll likely take them a few years to get down to their goal payout ratio of around 50% of adjusted EPS for the dividend. But I think over the long term of 10 plus years, Leggett and Platt will be a good company to own, in my opinion. And like I've said before, I think the current price of around $32, I think is what it's at right now, low 30s, is pretty attractive. The stock really didn't move all that much on the dividend increase announcement, which I would have expected it to, but that's probably just because I wasn't really expecting much of an increase at all. But Leggett and Platt already makes up about 5% of my dividend portfolio, so I'm personally not buying any more right now because although it is a solid company, I don't really see the dividend growth potential in the 7 to 10% range that I want to really focus on in my dividend portfolio. But I would love to hear any additional thoughts or feedback you might have on Leggett and Platt, and if you have plans to buy more shares at this point or maybe at some time in the future. If you have any questions, let me know as well. Thanks for watching, and I'll see you all in the next one.